The global financial system runs on a hidden agreement. It is an understanding that most people never see, but everyone, everywhere depends on. This agreement is not written into law. It is not formalized in a global treaty signed by world leaders. Yet, it shapes the price of the gasoline you put in your car. It influences the strength of national currencies Tokyo-Toronto. It quietly dictates the balance of global power, tilting the world's economic and political landscape. This is the story of the petrodollar, and today, in the long shadow of conflict and geopolitical tension, it may be facing its greatest test. It is a system born from crisis, and one that could be reshaped by it. To understand the immense shifts transforming our world today, to grasp what is truly at stake, we must first travel back in time. Our journey begins in the early 1970s, a decade that would redraw the map of global power. The world was in the grip of a profound and escalating crisis. The post-war optimism that had fueled decades of growth was beginning to fray. At the heart of the turmoil was the imminent collapse of the post-World War II economic order, an architecture of stability known as the Bretton Woods system. Forged in 1944, its purpose was to prevent a repeat of the economic chaos that had led to global conflict. For nearly 3 decades, that system had anchored the global economy by linking the United States dollar to gold at a fixed rate of $35 per ounce. Other countries, in turn, pegged their currencies to the dollar, creating a clear and reliable hierarchy. This arrangement fostered a remarkably stable and predictable environment for international trade, fueling an unprecedented era of global prosperity. The dollar was the world's reserve currency, its bedrock. It was, quite literally, as good as gold. But by 1971, the immense and escalating costs of the Vietnam War, coupled with ambitious domestic spending on President Johnson's Great Society programs, had put unbearable pressure on the United States. The nation was printing dollars to finance its deficits, flooding the world with its currency. Its gold reserves were dwindling at an alarming rate as more and more countries, sensing the imbalance, sought to redeem their excess dollars for the physical metal. The promise was becoming impossible to keep. So, in a move that shocked the world, President Richard Nixon unilaterally severed the dollar's link to gold on August 15, 1971. The Nixon shock, as it came to be known, was a declaration that the old rules no longer applied. The gold window was closed, permanently. Overnight, the anchor of the global financial system was gone. The world had entered the age of fiat currency, where money was backed not by a tangible asset, but by government decree. The United States dollar was no longer backed by a physical asset. Its value now depended entirely on something far more intangible: trust. Trust in the full faith and credit of the United States government. This decision plunged the global economy into a period of extreme uncertainty and volatility. Without the discipline of gold, inflation, the silent thief of purchasing power, began to soar across the developed world. Currencies, now floating freely, fluctuated wildly against each other, turning international trade and investment into a high-stakes gamble. The world was adrift without a reliable standard of value, a common yardstick for commerce. For Washington, the situation was perilous. The United States needed a new way to secure the dollar's central role in global finance, to ensure the world still needed its currency above all others. The crisis deepened dramatically in 1973 with the Arab oil embargo. The trigger was geopolitical. In response to American support for Israel during the Yom Kippur War, members of the Organization of Arab Petroleum Exporting Countries, or OAPEC, proclaimed an oil embargo against the United States and other allied nations. They turned off the spigots. The price of oil, the lifeblood of industrial economies, quadrupled almost overnight. The oil shock sent devastating shockwaves through the global economy, triggering a deep recession. This painful episode demonstrated the immense geopolitical power held by oil-producing nations. But within this crisis, American strategists saw a unique and powerful opportunity. United States officials, led by Secretary of State Henry Kissinger, saw a way to solve two critical problems at once. First, how to manage the massive destabilizing wealth flowing to oil exporters, and second, how to re-establish the dollar's unquestioned dominance in a post-gold world. The answer lay not in gold, but in black gold: oil. This strategic vision led to a series of high-stakes, largely secret negotiations between the United States and the Kingdom of Saudi Arabia, the world's largest oil exporter and the undisputed de facto leader of OPEC. The deal that emerged from these clandestine meetings was simple in its design, but utterly revolutionary in its impact. It would shape the next 50 years of geopolitics and finance. The United States would offer what Saudi Arabia most desired: an ironclad guarantee of military protection, access to sophisticated American weapons sales, and, crucially, a promise to ensure the survival of the Saudi royal family and the security of its vital oil fields from any external threat. In return, Saudi Arabia would perform two critical functions. First, it would agree to price all of its oil exports exclusively in United States dollars. As the leader of OPEC, it would then ensure that other member states followed suit. Furthermore, and this was the masterstroke, it would invest its surplus oil revenues, its petrodollars, back into the United States by purchasing U.S. Treasury bonds. This would help finance America's spending and keep its interest rates low. This ingenious arrangement effectively replaced the gold standard with an oil standard. It created a new, powerful, and self-reinforcing foundation for the dollar's global supremacy, ensuring that any country needing to buy oil would first need to buy dollars. A new order was born. The agreement between the United States and Saudi Arabia was more than a bilateral pact. It was a carefully engineered design. It quickly became the blueprint for a new global financial architecture, one built not on gold, but on oil. Soon, all members of OPEC, the powerful cartel of oil-producing nations, followed Saudi Arabia's lead. They unanimously agreed to price their crude oil exclusively in U.S. dollars. For oil producers, this decision offered a stable, liquid, and universally accepted medium of exchange, insulating their most valuable resource from the volatility of smaller currencies. This created a powerful, self-reinforcing loop, a mechanism that would come to be known as the petrodollar system. The logic was simple, yet its consequences were profound. Any country that wanted to buy oil, which was effectively every industrialized and developing nation on Earth, first had to acquire United States dollars to pay for it. This wasn't a matter of choice or convenience. It became a structural necessity of the global economy. This generated a permanent structural demand for American currency, a demand floor that was completely independent of the health of the United States economy itself. Whether America was in a boom or a bust, the world still needed oil, and therefore, it still needed dollars. As a result, nations around the world began to stockpile massive quantities of dollars in their central bank reserves. These weren't just for paying for energy needs. They became a primary tool for managing their own currency's value and ensuring financial stability. This constant global demand kept the dollar strong, giving the U.S. an immense economic advantage. And it kept borrowing costs for the U.S. government exceptionally low. But the cycle didn't end there. The second part of the mechanism was just as crucial: the recycling of these petrodollars. A significant portion of the dollars earned by oil-exporting nations was recycled back into the American financial system. These nations, now holding vast sums of U.S. currency, needed a safe, liquid place to invest them. The most logical choice was U.S. government debt, primarily Treasury bonds. These were seen as the safest financial asset in the world, backed by the full faith and credit of the United States. This created a captive market for American debt, which effectively financed America's growing national debt and kept domestic interest rates down for consumers and businesses alike. In essence, the world bought oil in dollars and then lent those same dollars back to the United States at low interest rates. America could run large trade deficits, importing real goods and energy, and pay for it by exporting paper and digital dollars, which then returned to fund its government spending. The dollar became the world's primary reserve asset, the undisputed king of currencies. It was the essential plumbing for global commerce and finance, the default currency for everything from commodities trading to international debt. For decades, this system proved remarkably resilient. It stayed stable through the end of the Cold War, the fall of the Soviet Union, numerous regional conflicts, and multiple financial crises. The fundamental logic held: as long as oil was the lifeblood of the industrial world, the dollar would remain king. Even America's staunchest geopolitical rivals had little choice but to participate. To opt out was to risk being cut off from the global energy market, a form of economic self-isolation that few could afford. The petrodollar system provided a predictable global order, but it was an order built on American terms, secured by American power, and centered on the American currency. This brings us to the central, unspoken question of our time. The system was built on a foundation of strategic alignment and mutual interest. It was designed for a unipolar world, guaranteed by a single dominant power. But what happens when that world order is fractured by conflict and the rise of new powers? What happens when the very financial systems that underpin this order are weaponized through sanctions, asset freezes, and restrictions on market access? Can a system built on trust survive in an era of pervasive mistrust, where access to your own reserves is no longer guaranteed? Current conflicts are not just about territory or ideology. They are a direct stress test on the architecture of global finance. The assumptions of the last 50 years are being challenged, and the answer to what comes next is being forged in the crucible of war. For decades, Iran has been the unwilling pioneer of a world outside the petrodollar, offering a preview of the challenges required to operate beyond the US-dominated financial system. Subjected to punishing sanctions since the early 2000s, Iran's economy was targeted for collapse. Access to SWIFT, the primary artery of international banking, was repeatedly cut off, making even legitimate trade nearly impossible. This extreme isolation inadvertently became a real-world laboratory for non-dollar trade. Iran was forced to build a parallel economic architecture based on trust, secrecy, and alternative value exchange. A vast shadow fleet of aging tankers emerged, often registered in jurisdictions with lax oversight. These vessels turn off their transponders to vanish from global tracking systems, engaging in clandestine ship-to-ship transfers to obscure their cargo's origin. Instead of dollars, Iran uses a complex web of alternative mechanisms. Intricate barter arrangements became commonplace. Much of its oil sales to its primary customer, China, are now conducted entirely in Chinese yuan. These yuan are held in Chinese banks to pay for imported goods, creating a closed-loop system that completely bypasses the dollar. Iran's survival demonstrates that the writ of the U.S. Treasury is not absolute. For nations like Russia, Iran's playbook, though costly, is a crucial case study in financial resistance and economic endurance. If China's de-dollarization is a long-term, strategic ambition, Russia's is an urgent, existential national security imperative. Following the annexation of Crimea in 2014, and especially after the 2022 invasion of Ukraine, Russia has been subjected to an unprecedented wave of Western sanctions designed to sever it from the global economy. The true financial thunderclap was the freezing of roughly half of the Russian central bank's foreign currency reserves, an estimated $300 billion in euros. This move crossed a financial Rubicon, demonstrating that reserves held in Western currencies were not sacrosanct assets, but potential levers of geopolitical power. For Moscow, de-dollarization is no longer a choice. It is the central plank of its economic survival. This has forced a rapid reorientation of its vast energy exports, pivoting from Europe to aggressively pursue new customers in Asia, primarily China and India. In a remarkably short period, Russia has become China's top oil supplier. The vast majority of those sales, once settled in dollars, are now settled almost exclusively in Chinese yuan, providing a massive, real-world stress test for using the yuan in large-scale commodity trading. A central pillar of this strategy is the Shanghai International Energy Exchange, or INE. Launched in 2018, its yuan-denominated crude oil futures contract was designed to compete with dollar-based benchmarks. While its volumes were once modest, the war in Ukraine and Russia's pivot to Asia have supercharged its relevance. Crucially, the contract is convertible into physical gold on the Shanghai Gold Exchange. By linking its oil contract to gold, China is attempting to back its nascent petroyuan with the ultimate hard asset, a clear signal to oil producers wary of holding a currency that is not yet fully convertible. Nestled between the Western-led financial order and the emerging Eastern Bloc is the Emirate of Dubai, a key hub within the UAE. It performs a delicate balancing act. While maintaining strong ties with the United States, it has become a haven for capital from sanctioned states like Russia and Iran, and is deepening its financial ties with China. Dubai's free zones make it a critical nexus where these competing economic worlds can meet and transact. Nearby, Qatar wields immense influence through liquefied natural gas, or LNG. As Europe scrambled to replace Russian pipeline gas, Qatar's role as a global energy linchpin was magnified. But its long-term focus is Asia. It has signed a landmark 27-year deal to supply LNG to China's Sinopec. As this strategic energy relationship deepens, the commercial and political pressure to price such contracts in yuan, rather than dollars, will inevitably grow. Amidst these shifts, the fate of the petrodollar system ultimately hinges on the decisions of its co-founder and undisputed keystone, the Kingdom of Saudi Arabia. Open to discussing trade in currencies other than the US dollar, Saudi officials, including the finance minister, have openly stated that the kingdom is open to discussing trade in currencies other than the US dollar. For 50 years, the Saudi commitment to pricing oil exclusively in dollars has been the bedrock of the system. Any deviation, even a small-scale deal with China priced in yuan, would have immense symbolic importance. It would mark the definitive end of the dollar's absolute monopoly and the official beginning of a multi-currency era in the global energy market. The petrodollar system, the bedrock of global finance for half a century, it's not facing a sudden dramatic collapse. The world won't wake up tomorrow to find the US dollar worthless. The system is too deeply embedded. Instead, the beginning of a profound evolution, not collapse, but gradual, accelerating fragmentation. A single, unipolar financial system is giving way to a multipolar order. The future is not replacement, but parallel systems. The dollar will remain the most important currency, but it will no longer be the only option for major international transactions. For global markets, the most immediate consequence will be increased volatility. Capital flows will become more cautious. They will be more sensitive to geopolitical events. For the United States, this era challenges long-held global leadership. The cost of financing national debt could rise. America must adjust. Economic dominance must be earned. This requires domestic economic strength. For other nations, a multipolar currency world brings opportunities and risks. Smaller nations may be pulled between competing blocs, US and China. For ordinary people, these shifts will filter down. Currency volatility can change the price of imports. As this great transformation unfolds, it will be revealed through a series of small but significant events and trends. The first and most important is the behavior of Saudi Arabia. A second critical sign to monitor is the diversification of central bank reserves. Third, pay close attention to trading volumes on the Shanghai International Energy Exchange. Finally, watch the language of world leaders and finance ministers. When de-dollarization moves into official communiques, it's a major shift. The future of the global money order is no longer a theoretical question. It is being actively debated and reshaped in real time as a new financial order quietly takes shape.